All right, here we are, back again. Okay. If you by chance didn't watch the last lecture, then why didn't you? You shouldn't be skipping any of these. You might want to watch the last lecture twice, even, because it was so important. And this one is an important one as well. Last time, just to review real quickly, we talked about going to the screen. Debit is the left side of the T account, correct? Credit is the right side of the T account. And we talked about how an account that is called a debit balance account increases when you debit it and decreases when you credit it. We talked about an account that's called a credit balance account increases when you credit it and decreases when you debit it, right? All accounts are debited and credited at times. We just need to know whether they're increasing or decreasing. Which accounts are debit balance accounts? Which accounts are credit balance accounts, correct? Now, there was a document that I was fishing around for last lecture that I didn't have, and I was mad at myself, kicked myself the rest of the day. But, it is, for you folks at home, it is in Angel, under the handouts for Chapter 2. But it looks like this. Let me go over to this. Looks like this. Does everybody here have one of those? No, who doesn't have one? Okay. I got a few, so why don't you pass those around. Whoop, there you go. Okay. Now, this is how you should do your, these are the things that you should put on your flashcards. Okay? Now, the way, I'm giving this to you so you can use this to make your flashcards. But don't let this replace the flashcards. Don't be trying to learn these by going, okay, let's see. Cash is a debit balance account. Accounts receivable is debit. Okay, good. I'm doing great. Inventory. No, they're all together, okay? What I want you to do is make flashcards, okay? Make your flashcards. Again, there's so much of this that is analogous with learning your multiplication tables. Okay? You need to know this stuff real quick. Build this foundation of accounting. You know, some people say this is an online media class. Why don't I do tests where you can take them online? Why do I, for the folks who take this as a media class or an online class, they actually have to come to campus to take the tests in the testing center. And I don't let them take their tests online at home. And some people don't like this, but the reason I do that is because if you allow people to take their tests online online at home, you're basically saying it's an open book test, aren't you?
Yeah, I do a little.
Huh? Yeah, it's just an open book test. Now think about if you were a kid and you were trying to learn the multiplication tables and you had a test that said 6 times 9 equals blank, 4 times 3 equals blank, 2 times 9 equals blank. But you had over sitting to the side your multiplication grid. How much learning actually takes place by you just saying, okay, 2 times 9 equals 18, 6 times 9 equals 54? Is there any learning that's going on? You're a good copier, right? So I just can, in good conscience, I cannot do this online class with open book tests on that you take from in front of your computer. Now I could ask, please don't use your book, but I don't know how you would monitor that. So that's why, for you folks at home, why I have you come to campus, because I feel like I'm doing you a major disservice in this class if you don't leave with a strong foundation of accounting. Accounting 2, managerial, your other accounting and business classes will be bad. Just like I'd be sending you into the world for geometry and calculus and statistics and advanced algebra if you didn't know your multiplication tables. And I can't do that. I couldn't live with myself. Okay? So, do your flashcards. Kim, let me see your flashcards. You did a great job on them. Okay? Give you an example. Okay? Here are Kim's. Equipment on one side is a debit balance account. It's an asset. It's on the balance sheet. Okay? Notes receivable. Debit balance account. Okay? Income tax payable. Credit balance account. It's a liability. It's on the balance sheet. Great job. Great job. How many people have done, as we speak, how many people, and be honest, God's watching, how many people have done their flashcards? Raise your hands high. Okay? How many people haven't done them, but they're going to do them eventually? Oh, you are the ones. For those who've done their flashcards, you get a Hershey's Kiss. Okay? For those of you who have done your flashcards, you get a Hershey's Chocolate Kiss. For those of you who haven't, not only do you not get a Hershey's Kiss, I want you to pick up the wrappers of the people who ate them when they're done. Okay? Remember, the difference is not between those who want to do flashcards and those who don't want to do them. The difference is between those who do them immediately versus those who, I can wait till tomorrow morning. Okay? Hopefully, Kim, you've already have a day or two of learning these balances. Cool? Okay, I also recognize that we're going to go over the homework here in a second, and I realize it's going to be a lot of credit, debit, credit, and it's kind of boring. I mean, this is the very basics of the basics. However, once again, I want to develop that foundation. Mr. Royal, did you make your flashcards?
Yeah, the right hand.
Okay, because I saw you eating a kiss. I was going to tell the cameras to come off while I struck you. Okay, you play soccer, correct?
I do.
Okay. Do you remember when you were a little kid and people were teaching you the very basics of soccer? Maybe you had a coach, or your dad or your mom or something. Like, don't toe kick, right? Remember how when you were a little kid you wanted to kick it on your toe? You're not supposed to kick it with your toe, are you?
Well, you're not theoretically no, but there are times you can.
There are times, but most of the time it's with your legs. Yeah. Or where do you head the ball, right?
Yeah, full head.
Yeah, and there's those basics of sports that you learn as a kid. How do you hold a bat? How do you throw the ball in? And those aren't really fun. Kids want to play soccer, right? Let's not learn the basics. Let's just go play soccer. But you have a lot more fun playing soccer in life if you have a good understanding of the foundational principles, don't you? Yeah. Have you ever played with somebody even at your age who does not have a good understanding of the fundamentals?
Yes.
And it's frustrating, isn't it? So that's what we're trying to do here in accounting. I know it seems kind of tedious. Debit, credit, debit. But I want to get that foundation so you'll enjoy your classes and enjoy your business career more should you have one. Okay? All right, so let's go over the homework. All right? Let's go over the homework. The first one I assigned was Quick Study 2-1. Quick Study 2-1. So let's go through that. All right, Quick Study 2-1. I guarantee you'll have one like this on the test. I guarantee. Okay? All right, identify the financial statement where each of the following items appear. Use I for income statement, E for statement of equity, B for balance sheet. Okay, accounts payable is on the balance sheet, right? Cash is also on the balance sheet. Rent expense is on the income statement. Office supplies is an asset. It is on the balance sheet. Prepaid insurance is a prepaid asset. It is on the balance sheet. Revenue is on the income statement. Office equipment is on the balance sheet. Cash withdrawal by owner is on the what? Statement of equity. And unearned rent revenue, where's that one? Balance sheet. That's a liability, correct? Unearned rent revenue. Good. All right, let's hop down to Quick Study 2-4. Okay. Identify the normal balance of the following accounts. Now, once again, when I ask you the normal balance of account, it's the same thing as asking you, how do you make that account increase? With a debit or credit. Okay? Okay, what is the normal balance of equipment? Debit. Wages expense is debit. Repair service revenue? Credit. Office supplies? Debit. Owner's withdrawals? Debit. Accounts receivable? Debit. Prepaid insurance? Debit. Wages payable? Credit. Owner capital? Credit. Very good. Very good. Okay, now we're going to ask in Quick Study 2-5, indicate whether a debit or credit decreases the normal balance of the following accounts. Okay? So, how do you decrease land? You credit it. How do you decrease service revenue? You debit it. How do you decrease interest payable? You debit it. How do you decrease accounts receivable? You credit it. How do you decrease salaries expense? You credit it. How do you decrease owner's capital? You debit it. How do you decrease prepaid insurance? You credit it. How do you decrease buildings? Credit it. How do you decrease interest revenue? Debit it. How do you decrease owner's withdrawals? Credit it. How do you decrease unearned revenue? You debit it. How do you decrease accounts payable? You debit it. Very good. Okay? Questions on that? Okay. Now let's hop over to quick study 2.3. Now I guarantee you will have a test question like this as well. Okay, this is a great way to see if you understand what's going on. Okay, identify whether a debit or credit yields the indicated change for each of the following accounts. Okay, how do we increase store equipment?
Debit.
We debit it. How do we increase land?
Debit.
We debit it. How do we decrease cash?
Credit.
Credit it. How do you increase utilities expense?
Debit.
You debit it. How do you increase fees earned?
Credit.
You credit it. How do you decrease unearned revenue?
Debit.
You debit it. How do you decrease prepaid insurance?
Credit.
Credit it. How do you increase notes payable? Credit it. How do you decrease accounts receivable? Credit it. How do you increase owner's capital? You credit it. Okay? That's it for the homework, wasn't it? Okay, let me go ahead, especially for the folks at home, and put the answers up there. Just leave it on the, while I'm talking, just go ahead and please leave it on the answers here. Don't show me. But once again, foundational stuff. A quick study like, well, actually, all four of these quick studies. If in a week, if you can't cover up your answers and answer these and get them like at least 90% or better, then you are way behind, okay? You're going to be way behind. These quick studies should be a good assessment of if you know what you're doing. As a matter of fact, when a student comes into my office and says, I'm really having trouble with accounting, I will sometimes get out a piece of paper that I've written these questions down, and I'll say, do this real quick for me, or sit here, right here, and do it. And if they don't do it well, if they don't get at least 80% or better of them, I'm telling them, here's the reason you're doing bad. You don't know your very foundational debit and credit balances yet. You don't know these things, okay? If you don't know how to do these, here, let me move it up. Show the last two. If you don't know these things in a week, and if you don't know them well, boy, I'd just go drop the class. I mean, I know that sounds dramatic, but again, you just have to know these principles. I'm going to assume at some point that you know these, okay? That you know these and that you know them well. All right, any questions on that homework? Awesome. Okay, you can come back to me. Okay. All right, let's go ahead now and let's talk about some important stuff here. We'll do a little review here. Okay, the chapter 1 way, going to the Elmo. Okay, the chapter 1 way. The chapter 1 way of recording transactions. Like, let's say we used $250 cash to buy office supplies, right? Okay, do you remember how we did that in chapter 1? We said cash decreases by $250, correct? And office supplies increases by $250, correct? You with me? Now, imagine that this was quick study 2.3. And I was going to ask you, how do we decrease cash? How do we decrease cash? What do we do?
On the right of the T account.
We debit it or credit it? How do we decrease cash?
Credit.
We credit it. How do we increase office supplies? We debit it. Okay? And we also learned last period about T accounts, didn't we? And we learned that, do two T accounts. We learned that the left side is always the debit side, the right side is always the credit side, correct? And you're going to notice when I do T accounts, I'm not going to keep putting debit, credit, okay? Just because of space and time, I'm just not going to keep doing that. But just understand, left side's always a debit, right side's always a credit. So let's do a T account for cash, and let's do a T account for office supplies. You with me? We learned that the way you record this is you credit cash, so you write this on the credit side, or more appropriately, you credit cash for $250, correct? And you debit office supplies for $250. Are you with me? Okay, good. Now, I want to actually point out something here that's real important. And let me just draw a little space here. There's actually a step that comes before this step. And what that step is called is making the journal entry. Or sometimes we call it making the JE, making the journal entry. And here's how that looks. And I'm going to write it out and then we'll talk about it, okay? Here's how this transaction's journal entry would look. Okay, that's how that journal entry would look. What I am doing, a journal entry is a way, it's a notation that we make that says that we need to go to the office supplies T account and debit it for $250. We need to go to the cash T account and credit it for $250. Are you with me? And that's what we do. We go to office supplies, debit it for $250. We go to cash, we credit it for $250. You with me? That is called making the journal entry. Have you guys heard about making journal entries in accounting? This is what we're going to be doing. We're going to be making a lot of journal entries. Okay? Now, when you make a journal entry, you list the accounts that are being debited first, and then you list the accounts that are being credited. Now, I didn't say you list the debit balance accounts first and then the credit balance accounts first, because actually both of these are debit balance accounts, aren't they? No, you list the accounts that are being debited first, and then you list the accounts that are being credited. But the journal entry is our way of saying that the next thing we need to do is go to the office supplies T account and debit it for $250, go to the cash T account and credit it for $250. Now, I want to be real clear here. This is called making the journal entry. Down here, what we call this is posting to the T account or the ledger. And we talked about the ledger last lecture. This is posting to the T account or ledger. This is making the journal entry. Now, lest I forget, on the test, I guarantee you I'm going to ask you to make journal entries. And what I'm going to want to see is things that look like this. But what always happens is on the test, I ask people to make journal entries, and I get a bunch of this. Folks, this right here that you see, that is not making journal entries. Make yourself a note of that. These are not journal entries. This is posting to the T account, to the ledger. This is a journal entry. Are you with me? Couple of things more about T accounts. Or I'm sorry, about making journal entries. The total that you debit always has to equal the total that you credit it. Now that's pretty obvious in this case because there's only one item being debited and there's only one item being credited. But we'll do an exercise today when more than one item is being debited and more than one item is being credited. Well, the total of your debits always has to equal the total of your credit column. You with me? And you will never ever see a plus or minus sign in a journal entry, just like you'll never see a plus or minus sign in a T account. Never, ever, ever. You with me? Let me show you some incorrect ways that people do journal entries. Okay? The correct one is up top. Let me show you some incorrect ways that people will do these. They'll do this. No, we don't do that. Okay? You list the accounts that are being debited first, and then you list the accounts that are being credited next. You with me? The other way that I don't like it, I like you to do it, or that's not proper, it's not just me. I want you to avoid doing this. No, I don't like that. The proper way is you scoot in, you indent those accounts that are being credited. You scoot them over there a little bit. You with me? Well, they didn't scoot this one over, did they? They did it right over here. But you list the accounts that are being debited, then you indent the accounts that are being credited. You with me? Every now and then I'll get something really wacky, and it'll be something like this. I don't know what's going on there. Okay? I don't know what's going on there. That is incorrect. Yes?
When you say that you list all the accounts debited first,
Yes.
do you mean, like, would we list the two that, like, correspond with each other and then do the other ones, or all the debits?
Oh,
And then
no, that's
all
good.
the-
You mean like if you're analyzing several different transactions? That's a great question. No, you analyze and do a journal entry for each journal entry, each transaction separately.
Okay.
Not summing up the whole period. No, you list just that one, and then the next transaction, and then the next transaction.
Okay.
No, unless it was a very unique entry where one transaction had that many debits or credits. You probably will not ever see that in this class. Okay. All right. I think the worksheet we're going to do here in class is going to be a big help to you. All right. Going back over to the PowerPoints here. This is another example of a journal entry. This is a journal entry. Couple things about here. There's the date. Usually you like to put the date out there to the left. Now the journal entry that I didn't have a date, so. Then you list the accounts that are being affected. You can see that they scooted over that capital for C. Taylor account. They indented it because it's being credited. Then you list the dollar amounts of the debits or credits. Never a dollar sign, never a plus or minus in a journal entry. And then they do this journal entry description or explanation. I usually don't do those, and I don't really require you to do them. Okay? Once again, going back to the Elmo, though, this is kind of more of the simplified approach of doing things. And a lot of times I won't even put that D and C there. Okay? You with me? Should put the date here. I'm going to say this one more time because it's very important, because students get it messed up. This is making the journal entry. This is posting to the T account of the ledger. You do this actually before you do this, because this is telling you how to do this. Are you with me? All right. Let me give you an example of what we're going to do. Let's say that let's say that one of the transactions we analyze is we get a loan of $5,000 cash, notes payable. Okay? Well, how is the Chapter 1 way that we would show that? Well, we would say cash goes up by $5,000 and notes payable goes up by $5,000, correct? Now, to help you transition from that Chapter 1 way to the Chapter 2 and beyond way, kind of think of this like it was quick study 2-3. How do you increase cash? What do? You debit it. How do you increase notes payable? You credit it. So now you do your journal entry. Cash is debited for $5,000. Notes payable is credited for $5,000. This is Chapter 1. And this is Chapter 2 and beyond. Okay? You with me? But when you analyze a transaction, maybe you can't go straight to that. So just do this way first. Do it the Chapter 1 way. Then ask yourself, how do I increase cash? You debit it. How do you increase notes payable? You credit it. And then use that to do your JE. Okay? I'm going to give you, Matt, will you hand one of these out to everybody, please? And you folks at home, I want you to work on this too. Show you what it looks like. This is a little handout we're going to do. This is called Mary's Gardening Services. Again, folks at home, everything should always be in your handout section under the appropriate chapter. But what I'm going to ask you to do is to analyze an account and then make the journal entry. Make the journal entry. Not the T account, but make the journal entry. And in this particular case, you can see that there's 3 debits and 1 credit. The total of the debits will have to equal the total of the credits. And then here is where you put your date. Okay? Now go ahead and work on that in class. If you have to do the Chapter 1 way first and transition, like I just showed you, go ahead and do that, okay? So we're going to take about 8-9 minutes, play some JCC snazzy music for you, and let's just work on that in class. Okay, you may not be done with this. The nice thing about being at home is if you're not done, just pause this and start us back up when you are complete. But we want to have some time to go over the answers. Okay. Now, let's take a look at this. Mine looks a little different than yours because I left some space to do some extra work. I really always encourage people to do that chapter 1 way and then transition to the chapter 2 way, but they always seem to kind of resist doing that. But that's the way I'm going to show the answers. Okay? Okay, on May 1st, Mary contributes $4,000 cash as well as an automobile valued at $6,500 and equipment valued at $700 into her business. If this were the chapter 1 way, what I would say is this. Cash goes up by $4,000. We're going to set up an account called automobile. That goes up by $6,500. And then we have another account called equipment that goes up by $700. And then what else is affected here, folks? Capital. Yeah. And we're going to just say capital, which is part of owner's equity. This is one of those situations that increases owner's equity or capital, right? So capital goes up by, what is that, 11.2? Okay. How do you increase cash?
Debit it.
You debit it. How do you increase an asset such as automobile?
Debit it.
How do you increase equipment?
Debit it.
How do you increase capital?
Credit it.
You credit it. Okay? Now let that, see now we're done, aren't we? We debit cash for $4,000. We debit automobile for $6,500. We debit equipment for $700. And we credit capital. We could put the owner's name there if we wanted. I'm not going to. For $11,200. And then, of course, here we put the date, right? Do the total debits equal the total credits? Yes, they do. But do you see how I transitioned from that to this? All right? And some people might say, well, couldn't you put these both in an account called equipment? Yeah, you could. I probably would set up a specific asset account called automobiles. But any questions on that? Let's go to the next one. On May the 4th, Mary buys some office supplies at Office Depot for $180 cash. Okay? Just ignore the journal entry for now. Let's do the chapter 1 way. Well, cash goes down by $180, correct? And office supplies goes up by $180, right? How do you decrease cash? You credit it. How do you increase office supplies? Okay? Well, there we should be done now, right? We debit office supplies for $180. Again, never a plus sign, never a minus sign, never a dollar sign in a journal entry. And we credit cash for $180. And we put the date here. Now make sure you're not saying things like cash contributed. No, there's not an account called cash contributed or cash spent. No. It's just cash. Okay? Just cash. Don't write sentences in your journal entries. You with me? All right, any questions on this? Let's go to the next one. On May the 11th, Mary provides services worth $200 to a client, Bob Jones. The client immediately pays $125 in cash to Mary, but Bob will pay the remainder at a later time. So, cash goes up by $125, correct? We also have an account called accounts receivable. That's that asset, because we're going to receive the cash in the future, correct? Accounts receivable goes up by $75. And then what else is affected? Revenue. We can book the entire revenue recognition principle, because we have provided the services. So revenue goes up by $200, correct? All right, how do you make cash increase? Good, debit it. How do you make accounts receivable increase? How do you make revenue increase? Credit it. Okay? Now, don't be thinking that this all has to like equal 0 as you add it up or anything. No, that's not the self-checking mechanism. What the self-checking mechanism is, I'll show you in a second. Cash is debited for 125. Accounts receivable is debited for 75. Revenue is credited for 200. And this occurred on May the 11th. The self-checking mechanism is always, do the total numbers in the debit column equal the total numbers in the credit column? And it does, right? If it doesn't, then you messed up. Okay? Learning to do what we're doing here is so important. I guarantee you on your first test for everybody, you have to make at least 8 or 9 journal entries. They'll probably be worth 2 points each. If you can't do them, you're going to miss 20 points right there. 18, 20 points. Okay? Because I'm kind of all or nothing on JEs. You either do it completely right or it's wrong. Okay? All right. Let's go to the next one. On May the 12th, Mary purchases some more equipment for $5,000 by making a down payment of $500 cash and setting up a note payable for the remainder. So what is affected here? Well, cash goes down by $500. Equipment goes up by $5,000, right? And notes payable goes up by $4,500. Is that correct? Okay. How do you make cash decrease? Credit it. How do you make equipment increase? How do you make notes payable increase? Credit it, right? So now we have our journal entry, right? We list the accounts being debited first. And then we list the accounts being credited. And you can do those in either order. It doesn't matter. Not minus 500, just 500. And notes payable, 4,500. And this happened on May the 12th.
Does that order really matter on the...
On here?
Yeah.
No. Between cash and notes payable, no.
Okay.
But it does the
Right.
accounts that are being debited first.
Right.
And see how I'm indenting these as well. Okay?
Yes.
But no, you could put notes payable before cash if you wanted to. One more. On May 22nd, Bob Jones from the earlier transaction pays the remainder of the money that he owes to us. How much did he owe us? 75. So cash goes up by 75 and accounts receivable goes down by 75, right? How do you make cash increase? Debit it. How do you make accounts receivable decrease? How do you make AR decrease?
Credit.
Credit it. Debit cash for 75. Credit AR for 75. Total debits equal total credits. This occurred on May 22nd. Chapter 1 way, Chapter 2 and beyond way. Now please don't resist, folks, to do the Chapter 1 way first. I saw a lot of people struggling out there, and it's like, I don't want to do that Chapter 1 way. Don't take the shortcut, okay? When I'm driving and I tell my wife, hey, I'm going to take a shortcut, you know what my wife knows from that point on? We're going to be later than if I would have just gone the way that was best, right? It always ends up taking us longer. Whenever you try to do a shortcut, it always takes longer. So do it the right way. Do it the Chapter 1 way until you are 100% confident. This is a skill that you need to have. For those folks who didn't make your flashcards, you going to make your flashcards? Okay, good. All right, let me give you your homework. And for you face-to-facers, after the cameras stop rolling, I've got a couple things to say to you real quick. But here's the homework for everybody. Okay? There is the homework. Quick study 2.6 and 2.8. Exercise 2.4 and 2.7. That was a good class period. I felt like we learned a lot. I felt like I did a really good job there. Did you guys? Okay. All right. Hey, we'll see you next time. Bye-bye.